This isn't inflation. It's the failure of the money itself. That distinction matters because what you're seeing isn't a normal market move. Gold exploding, silver accelerating, prices of real assets moving almost vertically. That doesn't happen when confidence is intact. It happens when trust breaks. This isn't investors chasing upside. It's capital abandoning paper. The shift is psychological before it's financial. People aren't asking how to earn more anymore. They're asking how not to lose everything quietly. And this hits closer to home than most realize. When a currency devalues at speed, prices don't rise evenly. Assets reprice first, wages lag, savings get diluted in real time. If you're holding cash, you're not standing still, you're moving backward. The real line has already been crossed. The market isn't debating whether the system is stressed. It's acting as if the experiment is ending. Shelter is replacing yield. Possession is replacing promises. So here's the question that forces you to pay attention. If real assets are being repriced because paper trust is evaporating, what does that imply about the value of money you're still holding? Because once confidence collapses, it doesn't wait for permission to reset. What's accelerating this isn't panic. It's the bond market quietly breaking first. For decades, the global system ran on a simple assumption. Sovereign debt was safe. There would always be buyers, especially for US bonds. That assumption is now being tested, and the stress is coming from an unexpected direction. Watch Japan. For years it exported capital, holding down yields around the world. That flow is reversing. Domestic yields are rising, and money is being pulled back home. When the world's largest creditor stops financing everyone else, the pressure doesn't show up slowly. It shows up all at once. This is where the problem stops being about interest rates. Long-term yields rise even as policymakers talk about easing. That tells you the market isn't responding to guidance anymore. It's responding to solvency risk, to the question of whether this debt can actually be rolled without destroying the currency behind it. Here's the reframing question that matters now. What happens when the bond market stops believing time is unlimited? Because once that belief cracks, currencies don't drift lower. They get repriced. And when that repricing starts, it doesn't stay confined to bonds. It forces everything else to move with it. Here's the proof that this shift is already underway. When a system is trusted, money looks for yield. When that trust erodes, money looks for certainty. You can see the change in behavior. Investors aren't piling into long-term bonds despite higher yields. They're backing away. That tells you yields aren't compensation anymore. They're a warning. Long rates rise even as talk of easing grows louder. That's the tell. Policy is no longer setting the price of money. The market is, and the market is pricing risk, not growth. Specifically, the risk that refinancing this mountain of debt requires dilution, not discipline. Notice what's missing from official reassurance. There's no claim that demand for sovereign bonds is secure. No promise that rollover will be painless. No confident statement that buyers are lining up. Silence matters when it surrounds the most important assumption in the system. This is where the story flips. Rate cuts used to calm markets. Now they raise suspicion. If easing is required just to keep the system functioning, then liquidity itself becomes the problem. More money doesn't restore trust, it exposes the shortage of it. Once bonds stop anchoring confidence, everything else has to adjust. Currencies absorb pressure, real assets reprice, and metals stop trading like commodities and start acting like balance sheet insurance. From there, the escalation stops being financial and starts becoming geopolitical. When debt stress rises, cooperation breaks down fast. Globalization doesn't fail because leaders argue. It fails because incentives change. Countries stop optimizing for efficiency and start optimizing for advantage. Tariffs replace treaties, access replaces trust, and currencies turn from bridges into weapons. You can see the shift in posture. Policy stops prioritizing a strong global system and starts prioritizing domestic leverage. A weaker currency becomes a feature, not a flaw. It boosts competitiveness at home while taxing participation from abroad. That move sounds technical, but its consequences aren't. It fragments alignment between central banks and forces everyone to act alone. This is where synchronization ends. Once major economies stop moving together, volatility stops being contained. Trade pressure feeds inflation, inflation feeds monetary expansion weakens confidence. Each loop accelerates the next. Here's the part that flips the story. What looks like trade policy is actually stress response. What looks like protectionism is preparation. And once economic tools are pulled into power competition, markets stop pricing efficiency and start pricing control. At that point, instability isn't a risk scenario, it's the operating environment. What follows is a global scramble for things that can't be created by policy. When trust in currencies and trade weakens at the same time, attention shifts away from finance and toward physical reality. Energy, metals, minerals, inputs that don't respond to speeches or balance sheet expansion. This is where the system stops pretending markets alone can solve shortages. You can see it in behavior. Governments move from regulation to acquisition. Mining becomes strategic. Projects that sat stalled for years are suddenly fast-tracked under national security language. Territories that once felt symbolic take on urgency because they sit on materials the future depends on. This isn't about chasing growth, it's about securing access. Silver and copper stop being treated like commodities and start being treated like infrastructure, like defense assets. And once materials cross that line, price stops being the main signal. Availability does. Here's the perspective shift that matters. When resources are framed as security, demand becomes non-negotiable. Governments don't wait for pullbacks. They don't debate valuation. They secure supply first and let markets adjust later. That rewires scarcity permanently. Supply can't respond fast enough. New projects take years. And in the meantime, pressure keeps building beneath the surface. Because when the world moves from trade to control, shortages don't resolve quietly. They compound. This is where scarcity stops being theoretical and starts breaking mechanisms. Silver isn't scarce because demand surprised anyone. It's scarce because supply can't respond. Most silver isn't mined intentionally. It's a byproduct of other metals. That means higher prices don't unlock more supply. They just expose how little flexibility exists. Now add timing, green energy, electronics, defense systems. These aren't optional buyers. They don't wait for corrections. When they need metal, they secure it. That pressure drains inventories quietly, long before headlines catch up. Here's where the system shows strain. Paper markets assume delivery is rare. They're built on settlement, not possession. But when enough participants decide they want the metal instead of the contract, leverage stops being abstract. It becomes visible. Watch how fast this escalates. Large holders stand for delivery. Inventories thin. Timelines stretch. Rules get adjusted to slow the flow. None of that is announced as failure, but every move points to the same constraint. There are far more claims than there is silver. And this is the moment that matters. Once people stop trusting settlement and start demanding substance, the pricing model changes. Price no longer balances supply and demand. Access does. What looks like a technical breakdown is actually a confidence event. When exchanges are trusted, paper works, contracts roll, cash settles. Nobody insists on delivery, but when trust thins, behavior changes fast. Possession becomes the goal. Paper becomes a question mark. And systems built on leverage feel stress they were never designed to absorb. You can see it in the signals. Delivery volumes spike. Settlement windows stretch. Rules get adjusted midstream to slow demand. Margin requirements rise. None of these are framed as alarms, but together they tell a clear story. The system is defending itself. Here's the detail that changes how you read it. When rules change during pressure, confidence doesn't stabilize, it drains. And drained confidence doesn't come back with reassurance. It comes back only with proof. At that point, the market splits. Those who accept cash remain inside the system. Those who demand metal move outside it. And once that separation forms, prices stop reflecting balance. They reflect scarcity. This is how a market shifts from liquidity to allocation. Not everyone gets what they want. Priority replaces access. And when that happens, the paper price stops leading reality. Now the center of gravity starts moving, and it doesn't move west. As paper systems strain, physical metal flows to where delivery matters more than benchmarks. Not where trading is fastest, but where possession is prioritized. This shift isn't ideological, it's practical. Buyers who care about certainty don't wait for settlement. They take custody. In parts of Asia, silver isn't treated as a side market or an industrial leftover. It's being absorbed into reserves, collateral systems, and long-term planning. Pricing reflects that urgency. Physical premiums rise, inventories clear quickly, metal that leaves circulation doesn't come back. This is where the idea of a single global price breaks down. On a screen, silver trades at one number. In the physical market, it trades at another. The gap persists because metal can't move freely anymore. Controls, approvals, and logistics slow everything down. Arbitrage fails. That failure is the signal. A unified market depends on prices converging. When they don't, trust in benchmarks erodes. Traders stop relying on spot. Buyers stop waiting. Sellers stop offering metal at theoretical prices. This is how a market fragments, and fragmented markets don't resolve through volatility. They resolve through repricing, led by the places that insist on delivery. At this stage, demand stops responding to price altogether. Once silver is treated as critical infrastructure, it exits the normal market. Defense systems don't pause for pullbacks. Energy transitions don't wait for corrections. When supply is required, it's taken. Cost becomes secondary to continuity. That shift matters because it locks demand in place. Governments don't broadcast stockpiling. Military procurement doesn't show up in commercial data. Metal disappears quietly, not because traders are hoarding, but because systems depend on it to function. Here's the detail that changes the math. Substitution isn't realistic in the short term. You can't redesign electronics, weapons, or power systems overnight. That makes demand rigid even as prices rise. The market can't ration usage through cost. It has to ration through access. This creates a hard floor that speculation can't explain. Not because investors believe in it, but because infrastructure requires it. The metal isn't being bought to flip. It's being bought to keep systems running. Once a market reaches that point, it stops behaving like a market. Allocation replaces price discovery. Priority replaces fairness. And when supply is limited, not everyone gets served. From here, the trajectory tightens into two plausible paths, and neither looks comfortable. One path is managed escalation. Prices keep moving higher, not in a straight line, but in bursts. Volatility becomes a tool. Sharp moves force repositioning, flush weak hands, and push metal into stronger balance sheets. Authorities tolerate the chaos because it quietly revalues what backs the system without formal defaults. On the surface, it looks disorderly. Underneath, it's controlled pressure. The other path is forced acceleration. A single failure pushes the system faster than intended. A delivery breakdown, a policy shock, a geopolitical move that drains supply at the wrong moment. In that case, rules change openly. Cash settlement replaces delivery. Access gets restricted. Paper and physical finally separate in a way that can't be reversed. Notice what both paths share. Neither restores the old market, neither brings back trust-based pricing. Both accept that the system must adjust around scarcity, not eliminate it. This is why timing feels strange. Moves happen before explanations. Signals appear after positioning. By the time a new framework is announced, behavior has already adapted. The next step isn't a surprise event, it's a decision point forming quietly, where momentum matters more than intent. Here's the insight that makes the entire sequence coherent. This isn't a rally, it's a repricing of reality. Fiat didn't collapse in one dramatic moment. It eroded through leverage, expansion, and delay until trust thinned beyond repair. What you're seeing now isn't panic, it's alignment. Assets adjusting to a system that can no longer promise stability. That's why liquidity feels uneven, why exits feel narrower than entries, why prices rise while access shrinks. The system isn't designed to let everyone convert at once. It never was. It's designed to reallocate quietly through friction and delay. The real transfer doesn't happen at the top. It happens during confusion. When benchmarks stop guiding behavior, when paper and physical stop meaning the same thing, when people realize too late that what they owned was a claim, not a thing. This is the layer most people miss because it doesn't announce itself. It unfolds gradually, then all at once in hindsight. If you want to understand how this transition continues, where pressure moves next, and how value is redefined when trust-based money gives way to constraint-based systems, follow for the next breakdown, because the most important shifts don't arrive with crashes. They arrive with a new normal.